In this video, we're going to consider one of the more interesting problems that faces a wealth advisor in terms of comparing whether insurance is to be treated purely as an insurance or is it to be treated as a risk cover plus an investment, right? So a lot of the investment products which are available in the market basically combine both the risk cover and the insurance within the risk cover and the investment within one product. And here we are trying to evaluate whether that makes sense or whether unbundling that is possible, right? We've already seen a product like the unit linked plans. They basically invest in equity markets. They can also invest in debt markets, and so equity or debt, plus they give a life cover as well, right? On the other hand, we could do the same using a mutual fund which invests in equity or debt. We've already seen various kinds of mutual funds that exist, and we take a life cover purely in the form of a term plan, right, which is just a plain insurance cover as we have seen in our previous sections. So the key question is a ULIP versus a mutual fund plus term plan, right? So either I buy a ULIP or I buy an MF plus a term plan, right? Here, the investment and risk cover are embedded in the ULIP. Here, we are treating the investment using a mutual fund, similar to what a ULIP is, and we are looking at a term plan to give us the insurance protection, right? The life cover is going to come here. So when we evaluate, we have to evaluate for the same amount of money and for the same risk protection levels, right? We are evaluating based on that, and then we are going to check where is one superior than the other and in what circumstances can people choose one over the other, right? So that's what our focus is going to be in this discussion. Before we go ahead, we should very quickly look at once again what are the various costs associated specifically with ULIP products, unit linked plans, right? There is a premium allocation charge levied to recover the initial expense incurred towards issuing the policy and the cost of underwriting. Usually in the first few years, this is high. Then there's a fund management charge, which is basically, managing the fund. It's levied as a percentage of value, before arriving at a NAV. Life insurance companies cannot charge fund management fees more than 1.35% per annum of the total assets under management, right? So 1.35% per annum, it cannot be more than that. So it has to be less than 1.35%. A term similar to this in the context of mutual funds is what is called as the expense ratio. Similar to this, we'll look at more details. Then there's a policy administration charge towards the paperwork, premium intimation, etc. that's covered. It could be either flat throughout the term, could increase at a predetermined rate, or it could just come for a few years and then go off. Depends from policy to policy. And then there are mortality charges towards insurance cover, providing the insurance cover. Typically, these charge compensate in case there is the event of mortality. So if you are in a ULIP, beyond a few years, the mortality charges go away because by then you have provided for your insurance cover automatically by paying the premium, right? In the ULIP, remember that you are paying a premium and hence that keeps adding up to your risk cover or investment corpus that is going to give the risk cover at the end. So over a period of time, as you keep paying the premiums, the mortality charges keep going down, right? So that's the broad premise of what we are looking at. So let's lay the principle of what we're going to cover. Let's assume that we are looking at about a 25 lakh cover, and for that we're going to pay a certain amount of premium. Typically the premium is going to be 5 lakh in the ULIP. We can calculate what is the 25 lakh cover for a term plan going to be, assuming that the age of an individual is about 35 years, right? We'll try and calculate it. And let's understand this premise with respect to what happens in the context of a ULIP. So let's take a look at this. And in this ULIP, what we are doing is we are paying a premium of 5 lakh rupees for 5 years. There's a cover for 20 years. And then there are some charges. So obviously it gives us a total sum assured of 25 lakhs. And we're looking at a certain premium allocation charge, which is 3% for the first few years and then 2% for the remaining years. We're looking at a fund management charge, which is fixed at 1.35 maximum. There is some sort of a loyalty addition which comes up where this basically gets subtracted from the overall costs. There is a policy administration charge that comes up, and then there is a mortality charge that's going to come. We have put these for the first few years, and then in this particular plan there's some sort of a wealth booster where charges go down by 1% in subsequently 15 years and 20 years if someone stays still here, right? So effectively that's the overall cost we are looking at, and it takes a sum of C8 to G8 and then subtracts E8 and H8 from it. Technically, we need to subtract the loyalty addition from the cost. So I will change this formula to A plus B plus the policy admin plus the mortality minus the loyalty addition minus the wealth booster whenever and wherever that comes. So let's calculate and see what those costs are in each of those years. So we find that in the initial few years there is a huge expense that comes up, right? So this basically pulls out about 6% expense for the first few years. Then it goes down to about 2.75. In a couple of years it's less than 2%, right? If you were to compare this with, let's say, a term plan for 25 lakh cover, typically a term plan for 25 lakh cover would come at a price point of somewhere around 3,000 rupees or something. For a 20-year term plan worth 25 lakh cover, it's going to be at somewhere around 3,000 rupees. So if I was to take that as a separate expense on my initial corpus of 5 lakhs, that's 0.6%, right? That's available on each of the years. I have to pay 3,000 rupees here. The remaining money is actually available to be invested, and that can get invested at a mutual fund where the maximum expense on a mutual fund is 2.5%, right? So total expense in initial few years is 3.1% and then continues to stay the same over all these years. But there are two interesting points that come up here. One, insurance is costlier initially and then reduces over a period of time. So we see about 72% overall cost versus, let's say, 62%. So it's a slightly costly product as compared to a term plan plus a mutual fund. That's one point that comes out. Second, in the long run, they're kind of going to be similar depending on what kind of performance comes out of it. And sometimes people believe that, buying an insurance is probably a useful thing if you do it in one shot, because the saving and the risk protection gets taken care in the same point if you're buying a ULIP at that point. Some of the others who feel that they want to manage money better can then reduce this MF expense as well. They can try and find funds which are doing better on the expense ratio front and hence take the total expense lower there as well. So technically speaking, there are possibilities that this overall expense is slightly lower. The second part which comes around what kind of fund management tactics or what kind of fund management skills are tested. Usually MFs are extremely transparent. So at all points of time, we know who's the best fund manager, which is the best fund, what is the return of the funds at various points of time. That's not so in the case of insurance. A lot of the times we don't know which are the best insurance funds which are available. And consequently, what ends up happening is we don't pay too much attention to how a certain fund has performed or is performing. So in that context, it is almost always cost effective to buy an insurance as a pure insurance product and invest the remaining amount in terms of a particular mutual fund. In fact, if we compare returns and we try and calculate the returns net of costs, essentially, we will realize that by taking out this 3,000 every year instead of paying this 5 lakh for this period, and we can invest the remaining 4,97,000 here each of the years for the first 5 years, and then let it be after that in terms of the overall amount that is there. So technically we have put in the same amount of money, but broadly we will end up being better off because initial few years where the corpus is being built, a lot of it is taken out in terms of expenses when we are looking at a ULIP. So if the growth rates are kind of in time value of money, this is going to be much more detrimental than, let's say, a lower expense at a later point of time. So almost always we will find that expense wise, it is better to go into a term plan plus mutual fund rather than going for a ULIP as such, right? So let's summarize our discussions. In some unit-linked plans, initial years costs could be as high as 10%. We saw something where the cost was around 6.5%, but it could be as high as 10%. It's an investment plus insurance product, so useful for those who lack the discipline and regularity. So you do it in one shot, essentially. You kind of close the investment in one shot, and you don't have to kind of cover that again and again. All ULIPs offer some tax benefits under Section 80C. We're going to look at this in the next section when we look at tax benefits in more detail. Then a ULIP offers a unique benefit which we have not discussed so far. You could do switches between asset classes. Usually, most ULIPs allow 4 switches every year. Up to 4 switches every year free of cost, which means you can go from equity to debt, debt to equity, equity to debt. There are some ULIPs which also provide you proportions of your fund could be invested in equity and debt. So asset allocation is actually free of cost here, right? So that's an advantage that ULIPs offer. Charges are deducted from the premium and then units are purchased. So when you look at a net asset value for a unit linked plan and you calculate the returns on unit linked plan, the charges have not been deducted as yet, right? So effectively, when you look at the NAV does not account for the costs here. So if you were to calculate return based on NAV of ULIPs, that's going to over report the return because the cost is from that amount that you take out. In the case of mutual funds, charges are already considered in the NAV, they're out. So practically this is a post expense calculation that's happening. Cost would hover around 2.5% usually. Pure investment product. You can add a term plan separately. Only tax saver MFs offer the tax saving. So these are the ELSS that we had discussed about. Switching cost is not zero in all the cases, right? While a switch is allowed, there may be entry or exit loads as well as taxation implications which are not there in the unit linked insurance plans. However, the charges are already considered in the NAV which is available, so you get a post expense NAV. In the case of ULIP, you get a pre-expense NAV. Remember this whenever you are calculating. Sometimes someone will say that NAV of a unit link plan went from 10 to 15 and that of a mutual fund went from 10 to 15. So they appear to be the same. That's not true. This is post expenses and this is pre-expenses. Expenses will be adjusted after you calculate the returns on this. So essentially, in the context of the investments, it is almost always advisable to buy a term plan and then with that put the remaining money in a mutual fund. This combination is going to be more effective both in liquidity terms so that you can manage money. Let's say tomorrow you don't want to invest, you can take out the money from the market. That's not available with all kinds of ULIPs that are there in the market, right? So that's broadly the discussion that we wanted to have around ULIPs and mutual funds. At this point of time, the insurance industry does end up charging a bigger amount of costs. I think as technology percolates into the industry and distribution of insurance products becomes simpler, then we would have a scenario where possibly over a period of time these products will start competing with each other. Most of the costs that come up in terms of premium allocation charges, etc., come as costs of distribution. Someone is selling it and there is a middleman in between and there is a brokerage being paid out for that. Over a period, that should get adjusted, right? That's it in this particular section. Couple of quick questions. Just recap very quickly, what are the key charges in a ULIP? And is it better to buy a ULIP instead of a term plan and a mutual fund for investment needs? Thank you.